Well, friends, good morning. So, let us discuss the topic of the day, that is catastrophic insurance in India. Catastrophic insurance in India. So, the catastrophic risk is one where a large number of people are exposed to the risk of a large loss by reason of the occurrence of a peril. It could be a natural calamity in the form of earthquakes, floods, droughts, or even terrorism attack resulting in loss of life, destruction of infrastructure on a large scale. The September 11 attacks, often referred to as 9/11, are the most dreaded example of the catastrophic terrorism attack. 9/11 was a series of coordinated suicide plan by Al Qaeda upon the United States on September 11, 2001, wherein, excluding the 19 hijackers, 2,974 people died in the attacks. The World Trade Center collapsed. The attacks left a significant economic impact on the United States and the world markets. The catastrophes have occurred many times in history at global level, also which affected many economies. Some of the most devastating global catastrophes resulting in loss of more than 10 million lives include the Taiping Rebellion, that is 1851 to 1864, and the famine of the Great Leap Forward in China, the Black Death in Europe, the Spanish flu pandemic, the two world wars, the Nazi genocides, the famines in British India, Stalinist totalitarianism, and the decimation of the Native American population through smallpox and other diseases. How countries are affected due to catastrophes? So, catastrophes can have serious implications on poor households as they do not have sufficient resources to protect themselves from disasters. In the event of a disaster, poor communities often resort to self insurance and informal means of risk management. If the intensity of the loss is not too severe and probability is high, self-financing and informal means of risk management are effective. However, in the case of probability, high intensity, a loss, self-financing and informal means of risk financing are ineffective. So, in the case of severe floods or droughts where the risks are systematic, the ex post informal means of risk management, including selling of assets, are there. As risks are correlated, therefore, large number of householders or household resort to selling their assets at the same time, which brings down the value of assets. The same holds true for wages. Poor farmholders resort to off-farm means of coping with their losses. Since the risk is spread over a substantial geography, the excess supply of labor and weakened financial capacity of the businesses depress the wages received. Therefore, systematic risks result in large scale loss on wages, income, and of the work. So it leads to growth in indebtedness, and vulnerable communities are caught in the poverty trap. So there are some insurance-based solutions, because the insurance-based solutions for managing catastrophic risk depends on the degree to which risks are transferred to the parties that ultimately bear the risk. National catastrophic insurance pool is there. A country can choose to pool the disaster risk when the risk is large enough and the correlation of risk between the participating clients is relatively low. Commercial microinsurance, that is distinguished from other types of insurance by its provisions of affordable cover to low income clients. Reinsurers can serve to diversify the risk that an individual insurance companies cannot offset internally, and finally transferring catastrophic risk to capital market through the use of catastrophic bonds is another mechanism, but remains an underdeveloped option in developing countries like India. Commercial insurance, individual contracts, it's good as it provides individual coverage against catastrophes, but it comes with the high cost of premium payouts. So the catastrophic insurance in India, to provide insurance companies must be registered in order to insure risk within the country, with the exception of marine cargo, which can be covered based on the terms of sale. Foreign investments and non-life ventures was limited to 26%, recently increased to 74%. When insurance is unobtainable from a local insurer, a petition may be made to the Insurance Regulatory and Development Authorities, that's India's insurance regulatory body, to insure internationally. Insurance in India for catastrophe risk is more a political economic issue than social economic issue. To date, there has not been a significant insured natural catastrophe in India. General Insurance Corporation and the major European professional insurers based on continental Europe and Asia performs the lead role in reinsurance. GICD continues to have the leading presence overall in the Indian market, providing the most reinsurance capacity for all classes of reinsurance. So increased damages and record-breaking events are there. In 2023, the world witnessed 398 notable natural disasters, resulting in a staggering $380 billion in economic losses. So these losses surpassed the estimated economic loss in 2022 and marked the hottest year on record, underscoring the urgent need for better disaster preparedness, risk reduction, and increased resilience. India is a seismically active region and is prone to some of the world's largest continental earthquakes. However, the frequency of large earthquake event is lower than for other earthquake-prone countries in Asia, such as China, Indonesia, and Japan. Cyclone is a significant peril in India, and flooding can often follow cyclone activity, where Bengal is more exposed to the damages of cyclone. Although the tsunami that struck India's southeast coast in December 2004 emanated from an underwater quake in the Indian Ocean, so infrastructure projects in rough terrain and for buildings in crowded urban environments are also exposed to catastrophic risk. Tea and other crops are prone to hail damages. So availability of insurance is there in India. Because windstorm insurance is provided in a standard commercial, industrial, fire and special peril policy. Insurance cover for wind losses encompasses losses resulting from destruction or damage directly caused by storm, cyclone, typhoon, tempest and tornado. Flood is also covered under the standard fire and special peril policy, as are subsidence and landslide, including rock slide, subject to certain exclusions such as the normal cracking, settlement or bedding down of new structure, and coastal or river erosion So earthquake risk is addressed by an extension to the fire and special peril policy, and it covers damage following earthquake and shock, fire following earthquake can be added. An estimated half of the commercial and industrial property policies in India carries earthquake cover. Health insurance is included in tree crops covers. Insurance for strikes, riots, and civil commotion is readily available and include cover for malicious damage. Terrorism is covered by a pool managed by the GIC. So the sole reinsurer in the Indian insurance market, local underwriters are prepared to cover terrorism risk, subject to a surcharge which is passed on to the pool. So the pool covers act of terrorism as well as loss and damage caused by a lawfully constituted authority is surpassing such acts. Fire and special peril policy are also increasingly popular among home and apparent owners and tenants. Challenges with catastrophe insurance are there because one challenge in bridging the large protection gap is limited awareness and perception of the risk. The industry also faces challenges in underwriting with a need for more granular data on existing natural catastrophic exposure and establishing more robust modeling capabilities. India has made strong progress in setting up early warning systems for tropical cyclones, but there is a long way to go on this front for other hazards, for example, floods. The provision of risk identification and forecasting is insufficiently developed. When it comes to a natural disaster, risk identification is the most critical aspect of risk management, as risk reduction and preparedness policies directly depend on the original assessment of risk. Additionally, forecasting the location, frequency, duration, and magnitude of the future catastrophic event is a major part of being prepared. So, as the cost attached to risk identification and forecasting of future catastrophic event is high, there are no clear pointers to define appropriate catastrophic premiums. Local level of the government can add a small levy to the property tax which can be used to buy insurance of property against catastrophes. Flat owners, cooperative societies and urban areas must be mandated to recover insurance premium along with maintenance charges and arrange insurance against catastrophes. All lending institutions, including housing loan corporations, central and state governments, etc., must obtain insurance or cause insurance to be obtained against catastrophes on compulsory basis. Similarly, all house buildings, societies and organizations like Urban Development Authority, City Development Authority, which are involved in construction, must be maintained to insure against catastrophes. So this is about the catastrophe insurance in India, and natural catastrophe exposures are growing nowadays because alongside the expanding economy and growing insurance market, India is exposed to many natural catastrophes including earthquake, flood, tropical cyclone, drought and wildfires. Our insurance protection against against natural catastrophe risk is low. Our resilience analysis indicates that 93% of exposures are uninsured. So economic losses due to natural disasters have been on the upward trend for many years, driven mainly by economic growth and rapid urbanizations. India's major cities have high population and asset value concentration, and many are exposed to multiple natural hazards. Thank you very much.